Welcome back, everyone, to another episode of Let's Talk Housing. My name is Brennan Thomas, and I am the co-host here alongside Stephen Thomas, the chief economist and founder of Reports on Housing. Today, we will discuss the most recent news and statistics as usual, what type of market we're seeing right now, forecasts, home insurance, and so much more. But first, Stephen, I wanted to ask you what is happening in the large Thomas household.
Not a lot. It's just not a tremendous amount. The kids are busy with school. We just finished soccer. High school soccer season just ended for Frosh Soft. Of course, varsity continues to go on, but now this is Alana. She moves on to she's now going to start track. She started track the very next day. That was yesterday. Today will be day 2 of track, and she'll be running track. She's multi-sport, so she keeps us very, very busy. But other than that, just running around. We have Mason training for a marathon, but him and his sister are going to be, they're going to some church camp over the weekend. Not a lot going on. Just not. Other than or how would we bring up Mason, or not Mason, Ezekiel. Ezekiel got hit in the eye by a Nerf gun and had to go to the hospital to make sure everything is okay. His eye has healed pretty much to this point, and everything looks good. So not a lot of exciting stuff going on. Birthday season's done, and now we're on to February, and yeah, everybody's saying, can't believe it's already February, but February was a long month with lots of birthdays for us. Anyway, that's what's going on for us. How about you, Brennan? Brennan Joseph, what's going on in your neck of the woods?
I'd say same old for me. Just loving soccer, loving life right now. Going to travel down to San Diego this weekend with my brother, your son, and visit his girlfriend and go see San Diego for a bit. So that sounds like fun, and got more soccer this weekend. Big games. I am terrified. I have faith though, and we just have so much more coming up this month. There's like a lot of games that are coming into play, and we're going to be playing like twice a week, and it's just going to be a lot of stress on my heart, but that's okay because it's all part of the sport.
So everybody needs to know that your team is
Arsenal. I usually forget to say that, but yes, it's Arsenal, and they're in England. I follow pretty much across all of Europe and the MLS here, and just like different, I guess, places. But for the most part, they own my heart for sure. Arsenal. They have for a while. So, but it's good. So, Stephen, like usual, what is happening in the real estate world with supply, demand, and expected market time?
Inventory, kind of like what we thought. Inventory is going to be flat for the winter market, and at the same time, we have demand pending sales just zooming higher. So when you have flat demand and zooming higher, flat inventory supply, and you have zooming demand, what you have then is the speed of the market speeds up like exponentially. It is way different now than where we were a month ago at the start of January. It right now is really starting to sing, and it's only going to get hotter as this winter progresses. That's one of the things so that's what we're seeing right now. Another great thing. So once we get to February, so that was yesterday, we were crunching numbers and data and looking into all the nuances of what happened in January. One of the biggest things that came out of January is we actually have more homes coming on the market than last January. Now, last January, the whole year, we were at this just extreme bottom, the fewest number of homes coming on the market that I had ever seen. And that was all due to the higher rates. Even though year over year rates are a little bit higher, we're actually seeing more homes come on the market. It's still way off compared to where we were prior to the pandemic. because normal number come on every single year. But during the pandemic, and especially once rates started to ratchet up and everybody was hunkering down in their homes with very low rates, unwilling to move, we saw fewer homes come in the market for the second half of 2022. All through 2023 was kind of a bottom. And now for the month of January of 2024, it's still off, but it's not off like it was January of 2023. So more homes are coming on the market. More homes coming on the market means what? More pending sales, because as these rates have come down from their highs of 8%, there are more buyers that are in the marketplace right now. So more pending sales means more closed sales, which is kind of like what we had forecasted for 2024, and we're already starting to see it.
Well, I know to some of you listeners, you may be wondering why we talk about rates so much. Our answer to that is that it guides the housing market. That's at least what we say. It has a direct impact on affordability and everyone in real estate. In this case, Stephen, we've seen rates hovering around upper sixes until recently, where rates have taken like large dives back down to mid sixes. What happened today with rates, and what can we expect following from the Fed meeting that was on the 31st?
So we had the Fed meeting on Wednesday. And following that, it was kind of the same as what they talked about before. Like, you know what, we're going to be very data dependent. We are going to cut. We just don't think it's most likely not going to be in March. And but they know that they're overly restrictive. Their rates too high. Inflation's coming down. They're more concerned about jobs and things like that. They're concerned about different things that they actually should not be super concerned about. They're actually too overly restrictive, and they should have reduced when they met on Wednesday. That is our own opinion, and we think it should have been a 3/4 point drop. Instead, they're very data dependent. They're going to wait. They're going to wait until it's all baked into the system, and it could cause more damage by being high for too long. That's my biggest concern. And also, they're not doing anybody a favor within real estate by keeping these high, because inflation's going to come down fine. So, but as a result, even after they met, you still saw interest rates float down a little bit more. There were a couple other economic readings that were positive. One of them being ADP. That's a private payroll report that came out, and it was less than expectations, as well as something the Bank of England said. So those things were bringing down rates, and they were looking really nice. And then today hit. Today is Jobs Friday. So the first week of every month, we get a job report. But the biggest thing about the January job report is there are a ton of revisions. It is so confusing to look at the nuances. Us, with our economic backgrounds, we look at it, you have to read it over and over to try to understand what it really means. And I'll actually be listening to an economic talk about this later today that has an expert on this, because this is not where my expertise is on housing. And that's where our economic expertise are. There is an economist that I listen to that actually that's their expertise, is jobs. So I want to understand, because there is a giant revision. It was way higher than expectations. Again, like last year, it wasn't 500 and some thousand like it was last year, but it was 300 and some thousand this year. I think it's like 333 or something ridiculous like that. Way too high. We didn't really add 333,000 jobs across the United States for the month of January, but this has to do with all of their fixing the books. And so as a result, we get a high number. So everybody made a big deal about it. What happened to rates today? Spiked up higher. We're right all the way back towards 7%. When I looked at the daily rate, it was at 6.92%, which is nearly 7%. We were making our way down towards 6.5%. So, you know what? I'm sad at that number. I'm sad at those revisions. I know that going forward that things will look a lot better, and we'll see that rates float down. It's just that this is going to prolong when that happens. And why am I sad about that? Because the number of pending sales and closed sales, the number of buyers and homeowners that are able to do things, it's far fewer when these rates are higher. So that's why I know that rates will be coming down this year, but now it's pushed back like another month. So that's uncool. But this is all the beginning of the year. I'll be fine once we get to March. But today's job reading was a little disheartening. It's good for the overall economy. I'm happy that the economy is continuing to do really well. However, in order for the Fed to finally say, you know what, we're done, and then we could say soft landing is all good, that's when they bring in their first rate cut. And now it's not looking like it's going to be March. It's looking like it's going to be later on in the year.
It seems as if rates have been hovering around the upper sixes, at least as of recently. With rates still being a little bit slightly elevated, Elizabeth Warren came out and blamed the Federal Reserve for being a part of the housing affordability crisis. Do you feel as if this was a little bit out of pocket, or do you agree with Elizabeth Warren?
Yeah, so the Fed is very data dependent, which means that rates go down the road as the economy cools. So they're waiting for all that to happen, even though if you look at trend analysis, which is what we do, you can actually see that the trend is it's going to cool. So it's just a matter of when, not if, and when it does cool down, we will get the rates that come down. That is what we need to see in order to get the housing market going again. Because as far as the number of closed sales for California for 2023, it was the fewest closed sales dating back to like 1980 something. So pretty ridiculous. Population was way less as well. So didn't do a lot of closed sales. We want to see that more homeowners and buyers are able to do things. What Elizabeth Warren is alluding to is the fact that exactly what we said, that the Fed should already be three-quarters. They're overly restrictive, but they're waiting. And they're waiting because they feel like they can. But this soft landing that they're trying to perform, the longer they wait, the less of the chance that we have that soft landing and we get more of a hard bump. And that hard bump would be in the term of more job loss down the road. That's actually what we're looking at. And we just don't want to see that. And that's what she's alluding to. She's alluding to the fact that we need to get the overall housing market going better than it is right now. It is what we refer to as a recession in units. We had a waterfall dive in the number of closed sales, which is it was spiked in 2021, but 2022, you could see it was starting off kind of like average because we didn't have that many homes on the market, and then it plummeted. And then 2023 was far fewer. So there's a lot of people out there that are unable to move, that are kind of like locked into their homes, or they feel like they can't move because their interest rates are so low. We are seeing more people come on the market, but we'd see a lot more when rates drop to low sixes down into the fives. And that can only happen if they make a move, and it's not going to damage the economy. It's not going to cause inflation to go up, contrary to what they're looking at. It's just they're overly restrictive, and they'll make this move and it'll be late, kind of like how they've been doing everything. Is everything they do, they are wait and see until it's fully baked, but they cause more damage by doing that.
So Redfin reported that homebuyers on a $3,000 monthly budget have gained nearly $40,000 in purchasing power since mortgage rates peaked last fall. If rates continue to drop, how much could they potentially afford?
Yeah, so affordability, this is what happens. Well, now affordability went the wrong direction, didn't it? Went from the mid sixes to 6.9. So we're making our way towards 7%. That eats into affordability. But purchasing power goes up as rates continue to fall. It's because you can actually afford more home when you plug in the interest rate to the payment that you'd like to see. So if the interest rate continues to drop and you want that same payment, as interest rates drop, you're able to afford more home. And it is a big, giant difference every time we go down a 0.5%, when we go down a full percent, it is noticeably different. That's why they're saying that they gained nearly $40,000 in purchasing power. That's across the United States. In some markets, like where we are, that savings was nearly $100,000. So that's when it goes down to where it needs to be. As it goes down further and makes its way from where it was, about 6.6% as of yesterday, but today it's at 6.9. Once it makes its way all the way down to 6%, it's just opening up the door to being able to afford more home, which opens up the door to a lot more buyers that are now able to get into the marketplace. And so that's what happens as values or as interest rates continue to go down.
Contradicting that, Wall Street Journal mentioned that the economy is looking as if it's returning to its normal look. However, housing still hasn't. What would you consider a normal housing market, and how far off do you think that we are from seeing one again?
Yeah, so they're saying that the economy's kind of been normal. That was kind of the way that 2023 is actually, we saw it was more robust than everybody had originally anticipated. A lot of that has to do with extra consumption, extra stimulus dollars, so excess savings, everything that the consumer has been doing and putting purchase on plastic, credit cards. That's going to come to a little bit of a head this year. That's why we're going to see somewhat of a slowdown. So what they're referring to is thus far, but that's because Americans, United States, very resilient. Nobody likes to consume like Americans do, but it comes to a point where, you know what, it's going to slow down. So that will happen because we can't continue to excessively purchase across the U.S. But as far as when the housing market was normal, they're right. So that was normal, but not the sector of housing. We talked about the lack of units. First, we had this big run up in values. Then values actually remained the same or went up slightly, and then but we're not doing any units. So there's buyers that would like to buy but can't, homeowners that would like to sell but can't because they have these low rates that they're hunkering down with, that they go, I can't trade this rate for something higher. That'd be dumb for my family. So as a result, it's really been stuck, and ever since COVID, it's been stuck. COVID was this weird year where we didn't do that many transactions. Then we had a late spring that lasted all the way through almost to the holidays. And then we had 2021, which was just off the charts. It was not even normal. We had inventories that were depleting because of how hot things were, with interest rates juiced starting off the year at 2.65%. And then you had 2022, you had nothing on the market by the time we got to 2022. And so at the very beginning, it was robust. Then we had rates that went up. So then all the charts were all squirrely. So they've been squirrely since 2020, not even a normal chart. The last time, and even 2019 wasn't normal. 2019 wasn't normal because at the end of 2018, the Fed was doing something back then as well, where they were making some changes, and rates were going up. So as a result, rates went up all the way to 5%, and it slowed the market so that it really started to slow. So we had this wonky second half of 2018. So 2019 started off with too many homes. So by the time we got to 2019, it was this weird curve also. The last time I could see a normal curve where things were actually normal was 2017. So that shows you the last time that we had normalcy was a heck of a long time ago. So I haven't seen a normal market. We're going on this. That's 7 years ago. Holy cow. That's a long time since things were normal. So it's just things have been abnormal. So everybody needs to listen to these kind of things, podcasts and economists and analysts that are looking at it, talking about it, because we're constantly, everything's changing year to year to year. Every year is a bit different. And so there's that normalcy just isn't here in the marketplace. And I don't anticipate it coming back to a normal market anytime soon.
So I just wanted to change the theme just a little bit. I can speak for everyone here at Reports on Housing that we do not like shedding light on clickbait headlines or articles, but rather we'd like to educate people on how dangerous some articles or headlines can be. The New York Post made an article saying that the U.S. housing market is a slow-moving train wreck. $700 billion could default, quoting from a real estate expert. This article didn't even go on to talk about the residential market, but rather the commercial market, as we all know, is in a rough spot right now. Stephen, what can we do to ensure that we are well educated and not misinformed?
Yeah, unfortunately, a lot of these articles, that is clickbait. They did that so that you'll read their article and then you find out it's about commercial real estate. And commercial real estate is this big wall of debt that's refinancing every started last year, it'll be this year, it'll be next year. It's like trillions of it's like over $1 trillion dollars of real estate. And what that is if you own a building, and a commercial building, you own it, but you have a loan on it, it's not a 30-year fix and it's paid off at the end. Instead, it matures and you have to get a new loan. The problem is most of that debt has really low interest rates pegged to it. And once they have to go out and it matures, they have to go get a new loan, these commercial buildings, they in turn, it's way higher, these rates. And sometimes when they're looking at it, it doesn't even make sense. They won't be able to afford the payment. The rents and everything else don't cover everything. So what ends up ultimately happening is these owners are actually walking away from their debt obligation and giving it back to the bank. This does not impact residential real estate. Instead, the residential real estate is doing its own thing, and it's been extremely hot and it continues to be hot even though interest rates are high because we have no inventory. That's been the story there. Commercial is a completely different thing. New York Post is not alone. There are so many articles that you read where they talk about, the housing is going to totally tank, and it has nothing to do with housing. It is just real estate, and real estate is this big umbrella that covers everything from land to commercial buildings to multifamily, and then residential real estate as well as new homes. And residential resale is different from the new homes market as well, but it all gets lumped in together. When they talk about new home sales, a lot of times people get it confused with residential resale, and it's just not the same. But they put these headlines so that you'll go ahead and click on it, and you find out, shoot, I just wasted my time and clicked on this and paid for advertisements and everything else. So those kind of things, they chap my hide as well. And it's just, we're in this kind of culture where we're constantly being fed these different articles. I belong to I have subscriptions to different papers, and I'd say about once every half hour, I get a new article that is pushed at me, and they're all clickbait stuff. Nothing about it. It's really positive. It's just the stuff that makes you go, oh my gosh, that happened. You want to click on it. It's just ridiculous. Unfortunately, that's where our culture's at right now. That's what sells.
So recently, housing forecasts have been readjusted, especially after recent demand, the pickup after the new year. Fannie Mae and Freddie Mac both put their prices forecasts around 3% for the year. Is this a likely outcome for California and the US?
Yeah, 3% is safe. That's just a safe little number that they came up with. 3% is if it's at 0, 1, 2, 3, it's all good. They hit it. Or if it's at 3 or if it's at 4, 5, 6, still close. 3 is safe, which is why what we've come up with is 3 scenarios for the year. And what we see in appreciation is if we get that slowdown for the spring, which I'm still thinking we're going to get it. It's just today's numbers and the reaction with interest rates, of course, mean it's a little prolonged, a little bit further than what I thought. But that scenario is where we see a bit more. We see that the 3 all the way up to 6% increase in values. But then if it's pushed off to summer, now we're looking at a little bit less, maybe 4% up in values. But then if it's pushed off even further, it could be really flat and actually be negative for the year, slightly down 1%, which we don't think that we're going to wait all the way until the autumn for the overall economy to slow. So this is why Fannie Mae and Freddie Mac have made these different calculations. But keep in mind also, Fannie Mae gets to change their forecast on a monthly basis. They have an economic forecast and a housing forecast, and it's changed constantly. And I've actually saved them over time just so that I could see how the evolution of their changing. And pretty much the evolution of the change in their forecast is whichever the way the wind is blowing that month. And then they prognosticate based upon that month where it's going to go for the rest of the year. It doesn't really it's not really much in trend analysis. It's more of what's today's trend, what's today's which way is the wind blowing, and it could be a storm 3 months from now, but that's not what they're projecting. They're projecting more of the same for the rest of the year type of thing. So I wouldn't give them much credence. They don't know. 3% is just a safe number.
Fannie Mae also came out saying that they predict mortgage rates under 6% by the year's end. What sort of market would we see then, and how would the inventory adapt?
Now, like I said, on that, the last question, yes, they get to change this every single month. And this is what I actually save more than anything else, is that one changes on a monthly basis, and it is a sea change based upon whatever's going on in the marketplace today. And based upon really what's going on today, in December, they said one thing. In January, they said, yeah, we'll have interest rates in the fives at the end of the year. That's not what they said in December. That's not what they said in November. They said sixes on up. And here we are now, it'll be in the fives. Well, that's beautiful. What will it be in February? Well, now that we have that jobs report, I'm saying that it won't be in the fives, it'll be in the sixes. So it's constantly a moving target, which just shows you how hard it is to prognosticate and state where you think rates are going to go anyways. But that's where the wind's blowing right now. So that was January. What you were talking about, it's going to be different in February when they release it in the middle of the month, unless we get a few other economic readings that will counter what we just saw today in today's jobs numbers.
So now that we are already a month into the new year and decently into the winter market, are we currently in a hot or a cold market? What are you seeing overall?
Yeah, it's like what I said in winter market. It's funny because the industry, they're notorious for saying it's Super Bowl. It is the perfect time to come on the market. And it just happens, the Super Bowl just happens to be right when the market starts really heating up. From the start of the year, we see this waterfall dive in the pace of the market, what we call expected market time. The lower that number, the hotter the market. So we start off the year at a high number and it just drops. Why does it drop? Because I talked about inventory. Inventory remains flat and we have demand that is surging. Well, when inventory is flat, demand surging, we get this big waterfall drop in expected market time. So it's getting faster and faster. Expected market time is our statistic. It's just this speedometer of the marketplace. It's based upon pending sales and the available number of homes to show your buyers. And basically, it's when you place your home on the market, when you expect it to open up escrow, or a pending, when is it becoming a pending sale? That basically is the true speed of the market right now. We're seeing it getting faster and faster and faster. We're watching these numbers start off really high. And I just did. We track a whole bunch of different markets, looking at all markets. Phoenix, Vegas, a lot hotter than everybody is anticipating in Phoenix, Vegas, Sacramento, Bay Area, right here in Southern California. It's all heating up, and it's like this across the United States. That is exactly what's coming on. It is getting hotter as this year progresses. And when does it typically, what's the hottest point? People think it's spring. It's actually not. It's because there are not that many homes that come on the market and everything's being dumped into pending status really, really fast. More homes start coming on the market once we get to spring, and then that counters all the buyers that are in the marketplace and that are coming into the marketplace. So actually, the hottest point typically is right around the beginning of March. And that's prior to spring, because spring really doesn't begin until the third week of March. So beginning of March is when we hit the hottest point, which is after Super Bowl. So the agents have it right when they talk about that, but that's just how it lines up on an annual basis.
Stephen, I was wondering if you can explain to our listeners why the case Shiller showed the first negative reading for home prices in 9 months.
The case Shiller, you have to understand, November, Shiller is old and slow. We're talking about November. That came out in the month of January. But it's not even the month of November. The way Shiller works is it brings in the 3 months prior, the 2 months prior to that reading. So it's not only just November, it's September, October, November. And then it's constantly moving around. But we have a lot of other home price indices that are way ahead of that, and reporting on December of 2023 already in January, and it's just for December. We follow the Freddie Mac Home Price Index, and there are others that are out there. Black Knight ICE has another one. There's a number of them, and this is what they do. They massage the models. I don't even need to come up with one. There's enough out there where that's what that's their claim to fame. So we can go ahead and look at what's going on with theirs. Shiller is just older and slow. And what did we have in the month of October that was in the midst of all that? We had 8% interest rates. Interest rates were above 7% from the end of July all the way through the first 2 weeks of December. So what happened is we hit a high of 8%. When we went from 7% to 8%, there's 5 million borrowers across the potential borrowers across the United States that, citizens that can no longer afford to purchase a home. So as rates go higher, it just gets harder and harder to qualify. And so as a result, it really did slow down our marketplace. We saw it. We didn't peak in inventory until we got to November, which is not normal. We normally peak in SoCal and the Bay Area. It's in the summer between July and the end of August. For the rest of the country, it's between August and September. And we have some markets that we follow that are August to September, right around the beginning of September. But here we are all the way in November. So those homes, we added inventory. And the reason we added more homes on the market is because we had such high rates that they would have sold had interest rates been at 7% or less. But because they were above 7%, we had a slowdown. And the slowdown was fewer pending sales, fewer closed sales. And as a result, when we had that slowdown and things were just ridiculous, buyers weren't willing to pay that much more than the asking price, or they had it lined up a little bit more in their favor. So we had values come down a little bit. And this is just an indication of what we're feeling. But not all markets were like this. This is the United States as an aggregate whole, and it's just a tiny percentage down. Year over year, it's actually increasing the numbers from October to November. The year over year numbers grew. So that's not what you're hearing about. You're just hearing about how it had a first negative number, and that's because of the season. It kind of slower towards the end of the year, and we had higher rates to put on top of that. So you sprinkle in all that, you mix it up, and what do you have? You have values that come down slightly, not a big deal. Right now, I can tell you where values are headed. They're headed north because of how hot the market is. It's going to counter all of that negativism. In February, we get December. We're still not even into January. Then in March, we'll get January. It's so old and slow, Shiller, that you shouldn't even be listening to it yet. It gets all the headlines because it was one of the first home price indices that were out there. But you can rely on so many others that will, by the time we get to March, we'll get to hear what happened in February, not January.
I was wondering, can appreciation pace of homes cause people to sit in their homes or age in place more? We've talked about the tax exclusion before, but I'm referring to annual home prices increasing each year by year.
Yeah, that people want to move. It's not they want to stay in their homes. People are staying in their homes a little longer than they did prior to the Great Recession, because everybody realized that you can't continuously trade your home over and over again, that it's not a commodity. And that's what people were treating it as a really quick, get rich quick type of thing. That's not the way it works. Now, right now we're erring on the side of people are staying in their homes for way too long, and it has more to do with the underlying interest rate being so low that they don't want to trade in this low rate. That's more of the issue now today than anything else. Plus, everybody's been qualifying. They have fixed rates. People used to get in pickles down back in the day. And prior to the Great Recession, there was adjustable rate mortgages. We've talked about this before, where they adjusted on a monthly basis, and the adjustments would be so large that people would go, I can't afford this, and they might have a problem with their job or whatever, and they can't get a new loan. So what do? They have to sell. A lot more people got into pickles back in the day. So when they got into pickles, they sold their home. So that created a lot more velocity in the number of closed sales that were out there. So appreciation, not necessarily that in of itself won't keep people from moving, because they can trade their house and sell their house for a different house in a different area, or a higher cost area, or bigger house, bigger home, spending more, or downsize. There's different things that people could do. They're just not going to do it as much in the current circumstances because of their low underlying rate, like I was talking about. But the tax exclusions, that would help things. What you're referring to is that you can take you purchase a home, and even if it goes up $500,000 as a couple, you get to move and not pay any taxes. $500,000 from where you purchased it, after all costs and everything that you put into the house, and paying all closing costs. You add it up, and if there's an extra $500,000 that's paid to you, then you don't have to pay taxes on that. Well, $500,000 is not enough, because some of these people live in their house for so long that they actually have more equity than that. And as a single, it's at $250,000. Now you're wondering, that seems like a lot. It's actually not. They came up with this and it's pegged at $1,997, that tax exemption. And $1,997 for $250,000 for a single person. Well, the median price home across the United States was $130,000. So $250,000 was nearly double. And right now we're at 400,000, right around there, for the median sales price across the United States. Double would make it like 800,000. So what they're saying is that the $250,000 should be moved to 500,000, not pegged to $1,997. Peg it to $2,024, and the $500,000 exclusion for couples should be at $1 million. And that will cover us for a while. And it should be pegged to something where it changes over time, so that we don't have to come back to this, because this helps people sell their homes, move to someplace else, not have a big tax consequence. It's just enabling Americans to move. People are saying, but it's a separation between the rich and the well-off and the middle class versus the people that can't get into it. It's unfair. But you know what? If you want more homes to be available and you want more inventory, this is keeping people in their homes as well. They don't want to move because they don't want to pay taxes. Now, if they don't have to pay taxes, they'll move, and then buyers can swoop in. Also, every time we have a move, it creates a lot of dollars, not just in the real estate industry, but let's say they have to buy a washer and dryer. That person gets paid a commission as well. They go out and they buy a television. That person gets paid a commission. You see how it works. It puts more economic dollars. The churn, the trickle-down effect from actually selling a home is pretty darned huge. And we got to start looking at different ways to change the needle on the inventory side of things, because we're going to be dealing with this lack of homes for a very, very long time.
So I've seen a topic resurface recently, and it's about home insurance. The Hartford Financial Service Group announced that they will stop offering new California homeowners policies in February. So as of yesterday for us, what can we do to help both insurance companies as well as homeowners going forward?
Yeah, so really, ultimately, it boils down to the state of California Department of Insurance, and this is happening. It's happened in Florida as well. So what's going on is they want to peg their policy rates at a higher value in order for them to make a profit. That's basically what they want to do. Now, this is called capitalism, but unfortunately, you just can't do that. You actually have to go through the Department of Insurance, and then they have to approve the rate. That process takes such a long time, takes over a year. And that process that takes over a year, guess what? A lot of times after it's done a year later, they say no. Well, then they have to go and they have to do it all over again, so they wait another year. Well, these insurance companies are losing so much money because of the different wildfires here in California, the flooding, and hurricanes in Florida, and there's other states that have their own issues. Well, at the end of the day, they need to make a profit, and if this is going to be the way that the system works, they're not going to play. And since they don't get what they want as far as rates are concerned, they don't have to do business in those states. So they're leaving those states altogether. Makes perfect sense when you talk about it like that. People are going, well, that's unfair. Well, it's not. They need to make a profit. And if they're not making a profit and dishing out a whole bunch of claims and they're not able to increase how much they're able to charge people, well, then they leave. And that vacating it creates fewer and fewer opportunities, and it causes a real problem. So Florida has their own insurance. So does California. And it's like the last resort insurance. It's not the way we want to do things. So quite frankly, these departments of insurances, like in these different states, need to figure things out and improve the process, and let's get this going again so people can actually get insurance. Yes, they'll be paying more, but they're not going to be paying more if under like it is under the current circumstances where everybody leaves. Then you have a real issue, and that's kind of where California is headed. Florida already headed that direction. So we need to fix that, and you can only fix that in the legislature or the Department of Insurance. A lot can be done. They just need to bring that to the forefront and deal with those kind of things that actually are breaking the backs of homeowners, people that live here, citizens here and in Florida and other states as well. So something needs to be done.
To conclude today's episode, I wanted to talk about Sheetz versus El Dorado County, which is a court case that is being pushed up to higher courts now, and it's over unnecessary impact fees in relations to traffic and future roads. Could it affect affordability when it comes to new builds, or are we looking at specific zoning cases with this court case?
That's the thing. Here it is. They have these impact reports, and I understand that building impacts the infrastructure and they need to charge for it. But the problem is the red tape, how much they're charging right now, has grown astronomically over time, to the point where what people want to build and what builders want to build is far larger, because if they're going to pay all this red tape, then they want to get the most bang for their buck. So the red tape equals lots of dollars, extra time, and as a result, it is what we're seeing is that we're not building the entry level housing, and that's not being addressed. So government needs to get out of their own way, and they need to make it an easier path for people to build. In other words, for us to actually increase the number of units that are out there, which will help the overall problem that we've encountered in lack of inventory homes available. So there are solutions to this, but once again, where does it lie? In the government's lap again. So they're blowing it. So is the Department of Insurance. We just talked about that. This is something that can be addressed, but then instead they squabble about the weirdest things in these legislatures. Like, man, this actually impacts so many people, as well as the insurance impacts so many people versus some of the things they talk about. Let's bring up the stuff that impacts so many people like today, and then you could deal with all these other nuance down the road.
Well, thank you again for tuning into another episode of Let's Talk Housing. Now, if you want to learn more about what's going on in the real estate industry, go ahead and check out our YouTube. Our name is Reports on Housing, or you can subscribe today at reportsonhousing.com. Please leave us a good review. We would greatly appreciate it. And if you have any questions at all, feel free to reach out to me through social media, or you can reach out to our email at info@reportsonhousing.com. We will see you soon, and have a fantastic rest of your day. Thank you.
Thank you.